Hollywood looks richer than ever. Bigger budgets, bigger stars, bigger platforms. Every headline says the same thing: growth, success, dominance. But here's the uncomfortable truth: an industry does not need to collapse to be broken. It only needs to stop making money. Behind the red carpets and record premieres, the American entertainment machine is bleeding cash, surviving on debt, accounting narratives, and the belief that tomorrow will fix what today cannot. This is not a story about bad movies or changing tastes. This is the story of how one of the most powerful industries in the world became a financial bubble, without anyone noticing. The American entertainment industry looks, at first glance, like the healthiest cultural machine on the planet. Budgets grow larger every year, premieres dominate global headlines, streaming platforms announce record subscriber numbers, and celebrity contracts reach levels that would have been unthinkable a generation ago. From the outside, everything signals expansion. Capital is flowing, content is everywhere, and the public narrative insists that Hollywood and the wider United States show business ecosystem are entering a new golden age powered by technology, global audiences, and endless demand for entertainment. Yet this surface prosperity hides a structural contradiction that becomes impossible to ignore once the numbers are examined without marketing gloss or accounting smoke. The industry is not growing stronger. It is becoming more fragile, more dependent on debt, and more detached from the basic logic of profitable enterprise. The illusion begins with scale. Larger budgets are routinely framed as proof of confidence and ambition, as if spending more automatically means creating more value. In reality, rising production costs often signal the opposite: diminishing efficiency. When a single film requires hundreds of millions of dollars before marketing is even considered, the margin for error collapses. A project no longer needs to fail to be dangerous. It only needs to underperform expectations. In earlier decades, a studio could rely on a diversified slate, where moderate successes balanced failures. Today, the economics have shifted toward a small number of extremely expensive bets, each of which must perform flawlessly across multiple markets to justify its existence. This concentration of risk is rarely discussed in public discourse, yet it defines the modern entertainment landscape. Streaming accelerated this illusion rather than correcting it. Subscriber growth replaced profitability as the primary metric of success, creating a narrative in which losses were reframed as investments in an inevitable future. Platforms reported expanding user bases as if those numbers were equivalent to cash flow, even when each additional subscriber increased operating costs faster than revenue. The market rewarded this story because it aligned with the broader financial environment shaped by cheap capital and a tolerance for prolonged unprofitability. Investors were trained to look past balance sheets and focus on scale, reach, and dominance. As long as growth continued, losses were forgiven. The entertainment industry adapted perfectly to this mindset, presenting itself not as a business that sells films, music, or series, but as a technology-driven ecosystem capturing attention. This reframing allowed structural weaknesses to masquerade as innovation. Traditional revenue streams, such as physical sales, syndication, and long-tail licensing eroded, replaced by flat subscription fees that capped upside while preserving downside risk. Yet instead of acknowledging this compression, the industry doubled down on spectacle. Marketing budgets expanded to match production budgets, creating a situation where visibility became as expensive as creation itself. The cost of convincing audiences to care began to rival the cost of producing the content they were being asked to watch. From a financial perspective, this is a warning sign, not a victory. When promotion absorbs an ever larger share of total spending, it suggests that organic demand is no longer sufficient. Meanwhile, headline numbers continue to reinforce the myth. Global box office totals, aggregate streaming hours, and social media engagement were presented as proof of vitality. What these figures obscure is distribution. Revenue became increasingly concentrated at the top, while the median project struggled to break even. A few global hits masked a widening field of underperforming releases, each quietly written down, restructured, or absorbed into corporate balance sheets. Losses did not disappear. They were deferred, amortized, or buried under future projections. The industry learned how to delay financial reckoning without resolving the underlying imbalance. This dynamic mirrors broader trends in the United States economy, where growth is often sustained through financial engineering rather than productive expansion. Entertainment became a perfect vehicle for this model because its output is intangible, its valuation subjective, and its success easily reframed. A film that fails to generate sufficient direct revenue can still be described as a branding exercise. A series that does not attract enough viewers can be defended as a long-term investment in platform identity. These narratives are persuasive, but they blur the line between strategic patience and structural denial. World news reinforces this tension. Labor disputes, cost-cutting measures, and sudden cancellations increasingly punctuate the industry calendar, contradicting the image of endless prosperity. At the same time, executive compensation and star salaries remain insulated from these pressures, reinforcing the perception that success exists even as the system beneath it weakens. Capital continues to flow into projects, not because they are expected to generate sustainable returns, but because the industry has positioned itself as too culturally important, too globally influential to fail in a visible way. What emerges is a system that looks rich but behaves defensively. Decisions prioritize perception over resilience. Growth is celebrated without interrogating its quality. Losses are tolerated as long as they can be explained, postponed, or reframed. The entertainment industry did not suddenly become inefficient or misguided. It adapted rationally to a financial environment that rewarded scale, punished caution, and treated attention as a substitute for profit. The illusion of a golden age persists because it is supported by narratives powerful enough to override balance sheets, at least for now. But beneath the premieres, the headlines, and the spectacle, the foundations are thinner than they appear, and the gap between appearance and reality continues to widen with each expensive success. The modern blockbuster is often presented as the ultimate proof of commercial success. Headlines celebrate opening weekends, global box office totals, and record-breaking debuts, as if these numbers alone define profitability. Yet beneath this narrative lies a financial structure that has quietly inverted the logic of filmmaking. Big movies no longer fail because audiences reject them. They fail because the cost structure has expanded faster than their ability to generate proportional returns. What appears to be a golden age of spectacle is, in economic terms, a period of extreme operational leverage, where even minor underperformance can erase years of expected profit. The first distortion begins with production budgets themselves. Over time, the definition of what qualifies as a major release has shifted upward. Projects that once would have been considered risky experiments are now positioned as tentpole events, carrying budgets that rival the annual output of entire studios from earlier eras. This escalation is not driven purely by creative ambition. It is driven by competition for attention in an overcrowded media environment. When every release is marketed as an event, none can afford to look modest. Sets grow larger, visual effects pipelines expand, shooting schedules lengthen, and talent costs rise in parallel. Each of these decisions appears rational in isolation, but together they create a cost base that demands extraordinary performance just to break even. Marketing compounds the problem. In the past, advertising was a tool to amplify demand. Today, it often exists to manufacture it. Promotional spending has risen to levels where it can equal or even exceed the cost of production itself. Global campaigns require localized strategies, multiple release windows, influencer partnerships, and continuous online presence. The goal is not merely to inform potential viewers, but to dominate cultural conversation for a brief moment. This approach is expensive by design. It assumes that without overwhelming visibility, even high-quality content will be lost in the noise. From a financial perspective, this signals diminishing organic demand and rising customer acquisition costs, a pattern familiar from other industries approaching saturation. Box office accounting then adds another layer of illusion. Gross revenue figures are widely reported, but they obscure how little of that money actually returns to the studio. Theater splits, distribution fees, taxes, and regional agreements erode headline totals long before profits are calculated. A film that appears to generate hundreds of millions globally may deliver a far smaller net return once these factors are applied. When budgets and marketing costs are combined, the break-even threshold often sits far above what casual observers would expect. This creates a narrow corridor where only exceptional outcomes produce meaningful profit, while average performance quietly results in losses. Studios have adapted to this reality by redefining success. A movie that fails to recoup its investment can still be described as strategically valuable. It may support a franchise, reinforce brand identity, or drive engagement on a streaming platform. These justifications are not entirely fictional, but they blur the boundary between revenue generation and narrative management. Financial accountability weakens when losses can be reframed as long-term investments without clear metrics for return. Over time, this practice trains both executives and investors to tolerate underperformance as a normal operating condition. The reliance on established intellectual property intensifies these dynamics. Sequels, reboots, and cinematic universes are perceived as safer bets because they come with built-in recognition. However, familiarity does not eliminate risk. It often increases cost. Established franchises command higher talent fees, more elaborate production values, and greater marketing commitments. Expectations rise alongside budgets, making disappointment more costly. When audiences respond with fatigue rather than enthusiasm, the financial consequences are severe. Yet the system continues to favor these projects because they appear predictable on spreadsheets, even when historical performance suggests otherwise. Corporate consolidation further amplifies the problem. Large media conglomerates spread risk across portfolios, allowing individual losses to be absorbed without immediate crisis. This cushioning effect reduces the urgency to correct inefficiencies. A poorly performing release becomes a rounding error within a diversified balance sheet, especially when supported by debt financing and cross-subsidiary accounting. The absence of visible consequences encourages continued escalation. Projects grow larger, not because they are more profitable, but because the system is structured to absorb failure without forcing change. At the same time, global expansion introduces new vulnerabilities. International markets are often cited as the solution to rising costs, yet they come with their own constraints. Revenue sharing agreements, regulatory barriers, and currency fluctuations limit upside. Cultural differences affect reception, making performance harder to predict. Despite this, global reach is treated as a justification for ever larger budgets, reinforcing a cycle where scale is pursued without proportional control over returns. What emerges is a paradoxical situation. The blockbuster model survives not because it consistently generates profit, but because it sustains confidence. Investors, partners, and audiences are encouraged to focus on spectacle and scale rather than margins. Financial success is measured by visibility and conversation rather than cash flow. This environment rewards ambition over discipline and punishes restraint by equating it with irrelevance. In this system, profitability becomes an exception rather than a baseline expectation. Studios do not need every film to succeed. They need the narrative of success to persist. As long as a few high-profile wins can be showcased, the broader pattern of underperformance remains obscured. The economics of modern blockbusters thus reflect a deeper shift in how value is perceived and justified. They are less about producing sustainable returns and more about maintaining the appearance of momentum in an industry that has learned how to grow larger even as its financial foundations weaken. If you want, next I can continue with the second half of this chapter, going deeper into accounting practices, franchise dependency, and how debt quietly props up blockbuster economics, or move straight into the streaming trap that follows. Behind the public narrative of spectacle and success, the financial mechanics that sustain modern blockbusters become increasingly abstract and detached from traditional notions of profit. Accounting practices play a central role in maintaining this detachment. Studios rarely evaluate a film as a standalone business unit. Instead, costs and revenues are distributed across corporate structures in ways that dilute responsibility and obscure true performance. Production expenses can be amortized over years, marketing costs can be classified as long-term brand investment, and losses can be offset against profits from unrelated divisions. This internal flexibility allows studios to survive outcomes that would cripple smaller businesses, but it also removes the pressure to correct inefficiencies. One of the most consequential tools in this process is the treatment of intellectual property. Franchises are no longer judged solely by the profitability of individual installments. They are valued as ecosystems that include merchandising, licensing, theme parks, and streaming engagement. This interconnected model creates a justification loop. A film may lose money directly, but it can still be described as essential because it keeps a franchise culturally relevant. Cultural relevance then becomes a proxy for financial logic. As long as an intellectual property remains visible, its economic drag can be rationalized as maintenance rather than failure. This logic has profound implications for capital allocation. Resources flow toward projects that promise continuity rather than efficiency. New ideas face higher barriers to entry because they lack historical data and brand recognition, even if their cost structures are more manageable. Established franchises, despite declining marginal returns, continue to absorb disproportionate investment. From an investor's perspective, this appears conservative. In practice, it concentrates risk while reducing flexibility. The industry becomes locked into expensive commitments that are difficult to unwind without admitting structural weakness. Debt quietly reinforces this behavior. Cheap financing has allowed studios to fund large-scale productions without immediate cash flow pressure. Borrowing spreads risk over time, smoothing earnings and stabilizing stock prices. However, it also introduces long-term obligations that constrain future decisions. Interest expenses accumulate regardless of creative success, and refinancing becomes necessary to sustain operations. As long as capital markets remain accommodating, this arrangement appears sustainable. The danger emerges when conditions tighten. Rising rates or reduced investor appetite can rapidly transform manageable leverage into systemic stress. Global market dynamics add another layer of fragility. International revenue is often treated as incremental upside, yet in reality, it has become essential to break-even calculations. Studios rely on foreign box office performance to justify domestic spending, even though international returns are typically lower after revenue sharing and regulatory costs. This dependency exposes projects to geopolitical and economic volatility beyond their control. Currency shifts, policy changes, or sudden market contractions can materially alter outcomes, turning optimistic projections into deficits overnight. Recent industry developments illustrate these pressures. Cost-cutting announcements, layoffs, and abrupt cancellations reflect an underlying effort to reconcile ambition with financial reality. These measures are often framed as strategic realignments rather than signs of distress, yet their frequency suggests a system under strain. At the same time, executive compensation structures remain tied to short-term metrics such as release schedules and headline performance, reinforcing incentives to prioritize visibility over durability. The erosion of profitability also affects the labor ecosystem. As budgets balloon at the top, margins compress below. Mid-level professionals face shorter contracts, longer gaps between projects, and reduced bargaining power. The economic middle thins while extremes expand. This polarization mirrors patterns seen in other sectors dominated by financialization, where capital concentrates while stability declines. The creative workforce absorbs volatility so that the system can preserve the appearance of success. Ultimately, the blockbuster economy persists because it aligns with a broader financial culture that tolerates inefficiency in exchange for scale. As long as losses can be absorbed, deferred, or reframed, the model remains intact. The danger lies not in a single failure, but in cumulative exposure. Each underperforming release adds weight to a structure already burdened by debt, inflated costs, and fragile assumptions. The industry continues to grow outward, but its capacity to generate genuine, repeatable profit grows thinner. This is how blockbusters stopped being engines of reliable return and became instruments of financial storytelling. They exist to signal confidence, dominance, and cultural power, even when the underlying economics suggest caution. The gap between perception and reality widens with every expensive release that succeeds narratively but falters financially. And as long as that gap can be bridged by accounting flexibility and investor patience, the illusion holds. When it cannot, the scale that once defined success will magnify the consequences. The streaming revolution was sold as the solution to every structural weakness in the American entertainment industry. It promised recurring revenue, global reach, data-driven decision-making, and freedom from the volatility of theatrical releases. Investors embraced the narrative quickly, treating subscriber growth as a substitute for profitability and market dominance as proof of future cash flow. For a time, this belief appeared justified. Platforms expanded rapidly, valuations surged, and traditional studios rushed to reinvent themselves as technology-driven content companies. Yet beneath the surface, streaming introduced a set of economic dynamics that transformed opportunity into obligation and growth into dependency. The core problem begins with the subscription model itself. Unlike box office revenue, which scales directly with demand, subscriptions impose a ceiling on monetization. Once a consumer is paying a fixed monthly fee, additional viewing generates no incremental revenue. This structure incentivizes platforms to maximize engagement while minimizing churn, but it does not reward individual successes proportionally. A hit series may drive signups, yet its financial impact is diluted across a flat pricing structure. Over time, this disconnect erodes the relationship between popularity and profit, forcing platforms to chase volume rather than efficiency. Content spending escalated as competition intensified. Each major platform concluded that exclusive, high-profile programming was essential to survival. This led to an arms race in which budgets expanded faster than revenues, justified by the belief that scale would eventually deliver profitability. Billions were committed to original productions not because they generated immediate returns, but because they were expected to secure long-term subscriber loyalty. The assumption was that once dominance was achieved, spending could be reduced. In practice, dominance proved fragile. Subscribers became more willing to cancel, sample, and rotate between services, undermining the very stability the model was designed to create. Financial statements began to reveal the strain. Operating losses were framed as transitional, while free cash flow deficits were explained as temporary investments. Debt filled the gap. Borrowing allowed platforms to sustain aggressive content pipelines without confronting the limitations of their revenue base. As long as interest rates remained low and capital markets receptive, this strategy appeared rational. However, it replaced one form of volatility with another. Instead of relying on unpredictable box office performance, the industry became dependent on continuous access to financing. Traditional studios entering the streaming space inherited these challenges without abandoning their legacy cost structures. The transition fragmented audiences and cannibalized existing revenue streams. Licensing income declined as content was pulled in-house, eliminating a steady source of cash in exchange for uncertain subscriber-driven returns. The promise of direct-to-consumer relationships obscured the loss of diversified income. What was presented as vertical integration often functioned as self-imposed concentration risk. Global expansion intensified the illusion of scale. International subscribers were counted alongside domestic ones, even though their average revenue per user was often lower. Pricing adjustments were constrained by local purchasing power and competitive dynamics, limiting the ability to raise fees. Currency fluctuations further complicated forecasting. Yet growth in international markets was celebrated as unequivocal success, reinforcing the belief that expansion alone could solve structural imbalance. Recent market signals have challenged this optimism. Subscriber growth slowed, churn increased, and platforms began to emphasize profitability over expansion. Cost-cutting initiatives emerged, including layoffs, content removals, and reduced production commitments. These moves signaled a shift from growth at all costs to financial discipline, but they also exposed the fragility of the underlying model. The same libraries that were once promoted as strategic assets were suddenly reevaluated as liabilities when their carrying costs exceeded their perceived contribution to retention. The experience of major platforms illustrates the broader pattern. Netflix pioneered the growth-first approach, normalizing years of negative cash flow in pursuit of scale. When growth slowed, the narrative shifted abruptly toward efficiency, revealing how dependent the model had been on constant expansion. Disney Plus entered the market with unmatched intellectual property, yet still encountered the same tension between subscriber numbers and sustainable margins. Warner Bros. Discovery faced the challenge of reconciling legacy debt with streaming ambitions, highlighting the difficulty of balancing old and new economics within a single corporate structure. From an investor perspective, streaming transformed entertainment into a capital-intensive service business with limited pricing power and high fixed costs. The valuation logic relied heavily on expectations rather than realized performance. Market sentiment rewarded user growth more than cash generation, encouraging behavior that prioritized headline metrics over long-term resilience. This alignment persisted until external conditions changed, forcing a reassessment of risk and return. The deeper issue is that streaming did not eliminate uncertainty, it redistributed it. Revenue became smoother, but profitability became elusive. Content costs remained volatile, while pricing flexibility diminished. Platforms assumed responsibility for financing production upfront, absorbing risk that was once shared across distributors, exhibitors, and licensors. In doing so, they concentrated exposure within their own balance sheets. The streaming trap is not a failure of technology or consumer demand. It is a mismatch between economic structure and financial expectation. The model excels at delivering convenience and abundance, but it struggles to convert attention into proportional profit. As the industry confronts this reality, it becomes clear that streaming did not rescue the entertainment business from its structural weaknesses. It amplified them, binding growth to debt and success to perpetual expansion. As the streaming model matured, its hidden constraints became hard to disguise. The promise of predictable, recurring revenue collided with the reality of escalating obligations. Unlike traditional distribution, where costs could be adjusted by scaling output up or down, streaming platforms lock themselves into continuous production cycles. Subscribers do not tolerate long gaps without new content, and algorithms trained audiences to expect constant novelty. This expectation transformed content from a strategic asset into a fixed operating requirement. Spending could no longer be paused without risking churn, turning flexibility into fragility. Pricing power emerged as the most critical weakness. Subscription fees were initially set low to accelerate adoption and undercut legacy competitors. Over time, these prices became psychologically anchored. Incremental increases triggered disproportionate backlash, cancellations, and negative publicity. Even when platforms raised fees, the gains were often offset by churn or promotional discounts designed to retain users. The ability to fully pass rising costs onto consumers proved limited. In economic terms, the industry discovered that demand for streaming was elastic in a way that theatrical attendance had never been. Viewers could cancel instantly, face no switching costs, and return later without penalty. Loyalty became conditional and transactional. This dynamic altered the risk profile of the entire entertainment ecosystem. Forecasting revenue grew more complex as monthly churn replaced seasonal box office cycles. Long-term planning relied on assumptions about user behavior that could shift rapidly in response to price changes, content availability, or external economic pressure. During periods of inflation and tightening household budgets, discretionary subscriptions were among the first expenses consumers reconsidered. This exposed streaming platforms to macroeconomic forces that they had previously dismissed as irrelevant to digital entertainment. Financial markets responded accordingly. Valuations, once justified by growth narratives, began to compress as investors demanded clearer paths to profitability. Metrics such as average revenue per user, customer acquisition cost, and lifetime value moved from internal dashboards to public scrutiny. The industry's ability to sustain high content spending without corresponding cash generation came under question. What had been framed as patient investment was reinterpreted as structural imbalance. Studios attempted to adapt by reducing output, consolidating platforms, and reintroducing advertising-supported tiers. These measures represented a partial retreat from the original streaming vision. Advertising reintroduced cyclicality and exposure to broader economic downturns. Consolidation acknowledged that the market could not support unlimited competitors at scale. Yet these adjustments also revealed the limits of innovation within the existing framework. Each solution addressed symptoms rather than the core mismatch between flat revenue models and rising production costs. The long-term implications extend beyond individual companies. Streaming reshaped audience expectations in ways that are difficult to reverse. Consumers now perceive vast libraries of content as a baseline entitlement rather than a premium offering. This perception constrains future monetization and undermines scarcity, a traditional driver of value in entertainment. When abundance becomes normalized, differentiation grows more expensive and less effective. Debt remains the silent enabler of this system. Even as platforms emphasize discipline, existing obligations persist. Interest expenses claim a share of future cash flow, reducing strategic options. Refinancing becomes a recurring necessity, tying the industry's fortunes to capital market conditions. A prolonged period of higher rates or reduced investor confidence would test the resilience of models built on leverage and expectation. From a broader economic perspective, streaming illustrates how financialization can distort an industry's incentives. Success becomes defined by scale and presence, rather than efficiency and return. Companies are rewarded for growth narratives, even when underlying economics deteriorate. This dynamic can persist longer than expected, especially when supported by cultural importance and consumer attachment. But it is not indefinite. The streaming era did not democratize profitability or stabilize entertainment finance. It shifted risk inward, concentrated costs, and normalized losses under the banner of innovation. What remains is a business that delivers unprecedented access and convenience, while struggling to generate durable margins. As the industry moves forward, it must reconcile the expectations created during its expansion with the constraints revealed by its maturation. The question is no longer whether streaming can grow, but whether it can sustain itself without continuous financial reinforcement. The financial architecture of the United States entertainment industry has produced a striking asymmetry. At the top, wealth, security, and bargaining power continue to expand. At the base and in the middle, income volatility, uncertainty, and downward pressure intensify. This divergence is not accidental. It is the predictable outcome of a system that prioritizes risk insulation for a narrow group while distributing instability across the broader workforce. The result is an industry where visible success coexists with widespread economic precarity, and where prosperity is concentrated even as aggregate profitability declines. Star compensation illustrates this imbalance with clarity. Leading actors, directors, producers, and executives command contracts that guarantee payment regardless of a project's financial outcome. These agreements are structured to protect personal income from operational risk. Upfront fees replace back-end participation, ensuring liquidity even when revenues disappoint. From a rational individual perspective, this shift is logical. In an environment where accounting practices can obscure profit and losses are common, guaranteed compensation becomes preferable to uncertain upside. Systemically, however, it transfers risk downward. When costs overrun or revenues fall short, the burden is absorbed elsewhere. The middle tier of the industry bears the brunt of this adjustment. Supporting actors, writers, editors, technicians, and creative professionals increasingly rely on short-term contracts with limited benefits. Residuals, once a stabilizing income source, have diminished in importance under streaming models that prioritize flat fees over long-tail revenue sharing. The erosion of these mechanisms removes a buffer that previously allowed professionals to build sustainable careers. Employment becomes episodic rather than continuous, forcing individuals to absorb gaps and uncertainty that were once mitigated by the system itself. Economic data reflects this polarization. Median incomes for creative workers have stagnated or declined in real terms, even as top-end compensation accelerates. The distribution of earnings skews sharply, with a small percentage capturing a disproportionate share of total payouts. This pattern mirrors broader labor market trends in highly financialized sectors, where scale and leverage amplify returns at the top while compressing stability below. In entertainment, the effect is amplified by the project-based nature of work and the weakening of collective bargaining power in the face of globalized production. Recent labor disputes brought these tensions into public view. Strikes and negotiations highlighted the gap between headline budgets and individual livelihoods. While studios emphasized rising costs and financial pressure, workers pointed to declining residuals and increased workloads. Both narratives were accurate, yet they revealed different layers of the same problem. The system generates enough capital to sustain executive compensation and star fees, but not enough to maintain broad-based security. The industry is not short of money. It is short of distributable profit. Corporate incentives reinforce this outcome. Executive performance is often measured by short-term metrics such as subscriber growth, release volume, and stock price performance. These indicators reward expansion and visibility rather than cost discipline or workforce stability. Cutting middle-tier expenses produces immediate savings without threatening headline appeal. Reducing star compensation or executive pay, by contrast, risks public perception and internal power dynamics. Rational decision-making within this incentive structure naturally favors measures that preserve the top while compressing the base. The disappearance of the entertainment middle class has long-term implications. Creativity thrives in environments where individuals can take calculated risks without facing existential financial consequences. When stability erodes, risk tolerance declines. Professionals become more cautious, less experimental, and more dependent on established formulas that promise employment. This dynamic feeds back into the creative stagnation often criticized in the industry, where franchises dominate and innovation appears constrained. Economic pressure shapes creative output as much as audience preference. Geographic dispersion further complicates the picture. Production incentives and cost considerations drive projects across states and countries, fragmenting labor markets. While this can reduce expenses for studios, it increases insecurity for workers who must relocate or compete in unstable environments. Benefits tied to long-term employment become harder to maintain, and collective standards weaken. The global labor pool increases flexibility for capital while reducing leverage for individuals. From an investor's perspective, this stratification is both a symptom and a risk factor. Concentrating rewards at the top may preserve short-term confidence, but it undermines the ecosystem that generates value. Talent pipelines narrow, institutional knowledge dissipates, and turnover increases. Over time, these effects can raise costs and reduce quality, offsetting savings achieved through compression. Yet these consequences are diffuse and delayed, making them easy to ignore in quarterly reporting cycles. The contrast between visible wealth and underlying insecurity sustains the illusion of health. Red carpet events, high-profile contracts, and media coverage reinforce the perception of abundance. Behind this facade, the majority of participants experience an industry that offers less predictability and fewer pathways to sustainable success. This divergence allows the system to appear prosperous even as its foundations weaken. In economic terms, the entertainment industry has adopted a distribution model that favors capital preservation over income circulation. Money flows upward efficiently, but struggles to flow outward. The result is an ecosystem that looks vibrant from afar, but operates with increasing internal tension. As long as top-tier compensation remains insulated and investor narratives remain compelling, this structure can persist. The question is not whether it is sustainable indefinitely, but how much creative and economic capacity can erode before its consequences become visible at scale. The long-term cost of this imbalance is rarely captured in quarterly reports, yet it compounds quietly across years. When an industry systematically transfers volatility downward, it does more than weaken individual livelihoods. It reshapes incentives, alters career paths, and changes who is willing and able to participate. Entry into entertainment increasingly requires personal financial buffers, external support, or tolerance for prolonged instability. This filters the talent pool in ways that are economically rational but creatively restrictive. Those without independent means face higher barriers, while those who remain often prioritize survival over experimentation. This shift also changes negotiation dynamics. As opportunities become scarcer and competition intensifies, leverage moves decisively towards studios and platforms. Individual contributors accept less favorable terms in exchange for continuity, reinforcing a cycle where insecurity becomes normalized. The erosion of residual-based income accelerates this trend. Without participation in long-tail success, workers lose alignment with the performance of the content they help create. Compensation becomes detached from outcomes, removing incentives for long-term investment in quality and durability. From a macroeconomic perspective, this resembles the hollowing out of a productive base. Value creation continues, but value capture narrows. Money circulates less within the ecosystem and accumulates more at its peaks. This concentration reduces multiplier effects that once supported ancillary businesses, training institutions, and regional production hubs. Secondary economies dependent on stable entertainment employment weaken, increasing reliance on subsidies and incentives to attract projects that offer diminishing local benefit. Financialization deepens these effects. As entertainment companies align more closely with capital markets, decisions increasingly reflect investor expectations rather than operational sustainability. Workforce stability becomes a variable cost to be optimized, not a strategic asset to be protected. The narrative of flexibility masks a transfer of risk from balance sheets to individuals. In periods of growth, this risk is tolerated. In downturns, it becomes visible as sudden layoffs, project cancellations, and career disruptions that ripple outward. World events amplify this fragility. Economic slowdowns, inflationary pressures, and shifts in consumer spending disproportionately affect discretionary industries. When households reduce entertainment subscriptions or attendance, revenue pressure intensifies. Companies respond by tightening budgets further, often at the expense of mid-level roles. The top remains buffered, while the base absorbs adjustment. Each cycle reinforces the same distributional pattern, making recovery uneven and slow. The psychological dimension matters as well. Persistent insecurity alters professional identity. Creative work becomes transactional rather than vocational. Long-term skill development gives way to short-term adaptability. This erosion of continuity undermines institutional memory and mentorship, weakening the mechanisms through which expertise is transmitted. Over time, the industry risks losing not only stability but depth, as experience fragments and accumulates less effectively. Investors often underestimate this human capital component because it does not appear directly on balance sheets. Yet its degradation has measurable consequences. Projects face delays, quality variability increases, and coordination costs rise. What appears as savings in labor expenditure can reemerge as inefficiency elsewhere. These costs are diffuse and difficult to attribute, allowing them to persist without clear accountability. The paradox is that the very strategies designed to protect profitability at the top may undermine it in the aggregate. By insulating a narrow group and externalizing risk, the system preserves confidence while eroding resilience. This trade-off can persist as long as capital remains patient and alternatives remain limited. It becomes dangerous when external conditions change or when accumulated strain reaches a threshold. The entertainment industry thus finds itself in a familiar position within modern capitalism. It showcases wealth, influence, and cultural power while operating on a labor model that grows increasingly brittle. The disappearance of a stable middle is not merely a social issue, it is an economic signal. It indicates that value creation and value distribution have diverged to a degree that threatens long-term sustainability. As this chapter closes, the pattern is clear. Stars and executives remain symbols of prosperity, reinforcing the image of success. Beneath them, a widening base of workers carries the volatility that makes that image possible. This structure sustains itself through narrative, inertia, and financial engineering. But like all systems built on imbalance, it accumulates pressure quietly, waiting for a moment when confidence alone is no longer enough to hold it together. At this stage, the American entertainment industry no longer fits the classical definition of a cyclical business struggling through temporary adjustment. Its behavior, incentives, and survival mechanisms align far more closely with the anatomy of a financial bubble. Not a bubble defined by sudden collapse or speculative mania alone, but one sustained by expectation, leverage, narrative control, and the systematic postponement of consequences. Understanding why requires stepping back from individual companies or platforms and examining the system as a whole. A financial bubble forms when valuation and resource allocation become disconnected from underlying cash generation, yet continue to expand because participants believe future conditions will justify present losses. This is precisely the environment in which United States show business now operates. Content budgets grow faster than revenue. Employment expands and contracts violently without restoring profitability. Debt accumulates even as returns weaken. Still, capital continues to flow, justified by scale, cultural relevance, and the assumption that entertainment is indispensable. These beliefs replace discipline with faith. One defining characteristic of bubbles is the redefinition of success. In the healthy industry, success is measured by a sustainable profit, efficient capital use, and repeatable returns. In a bubble, success becomes narrative-driven. Growth is praised regardless of cost. Market share outweighs margins. Visibility substitutes for viability. The entertainment industry exhibits all of these traits. Films, series, and platforms are declared successful based on reach, engagement, or cultural impact, even when their financial contribution is negative. Losses are tolerated as long as they align with the story of eventual dominance. Cheap capital has been the silent accelerant. For years, borrowing costs remain low enough to make prolonged unprofitability survivable. Debt-funded expansion masked inefficiencies and softened investor scrutiny. In this environment, financial discipline appeared unnecessary, even counterproductive. Companies that prioritized restraint risked losing relevance, while those that spent aggressively were rewarded with higher valuations. This inversion of incentives encouraged behavior that would be irrational under normal conditions. As in all bubbles, the availability of easy money did not create poor decisions. It removed the penalty for making them. Another hallmark of bubbles is the absence of cleansing failure. In functional markets, unprofitable models eventually contract or disappear, freeing resources for more efficient uses. In the entertainment sector, failure has been neutralized. Losses are absorbed through restructuring, write-downs, mergers, or refinancing. Projects are canceled quietly, costs are reclassified, and underperformance is reframed as strategic repositioning. The system protects itself from visible collapse, but in doing so, it prevents renewal. Capital remains trapped in low-return structures, sustaining stagnation beneath apparent growth. The global dimension reinforces this dynamic. International expansion is frequently cited as proof that the industry cannot fail, yet it often deepens vulnerability. Lower average revenue per user, regulatory friction, and currency exposure reduce profitability even as subscriber counts rise. Growth abroad supports valuation narratives while contributing less to cash flow than assumed. This mirrors historical bubbles, where geographic expansion delayed recognition of structural weakness without resolving it. Investor psychology completes the loop. Entertainment occupies a unique cultural position, blending economics with identity and influence. This makes it easier to justify exceptional treatment. Losses are excused because content shapes narratives, soft power, and consumer behavior. The industry is perceived as too important to contract sharply. That belief attracts capital, even when fundamentals deteriorate. As long as confidence holds, the system persists. When confidence weakens, the adjustment can be abrupt. Importantly, bubbles do not burst only through catastrophe. They can deflate through prolonged stagnation, declining returns, and gradual erosion of value. The entertainment industry already exhibits these signs. Margins compress, output increases without proportional gain, and consolidation replaces innovation. The system survives by becoming heavier, not healthy. Each cycle of adjustment leaves it more dependent on external support and less capable of self-correction. This is why the question is not whether the entertainment industry will collapse tomorrow, but whether it can continue to justify its scale under tightening conditions. Rising interest rates, shifting consumer priorities, and investor demand for real returns all challenge the assumptions that sustain the expansion phase. If capital becomes selective, narratives lose power. If debt becomes expensive, inefficiency becomes visible. If growth slows, losses lose their alibi. The entertainment industry has not yet reached this reckoning, but its contours are clear. The gap between appearance and economics, between cultural dominance and financial fragility, defines its current state. This is the essence of a financial bubble, a system that looks strong because it is large, not because it is sound. In the next part, the focus turns to what happens when this type of bubble meets resistance. Not a dramatic implosion, but the slow, grinding pressure of reality. How correction actually unfolds, who absorbs the cost, and why the end of the illusion rarely looks like the end of the industry, but rather its quiet transformation into something smaller, more cautious, and far less glamorous. When financial bubbles encounter resistance, they rarely collapse in a single dramatic moment. More often, they enter a phase of managed decline, where adjustment is spread across time, participants, and narratives. The American entertainment industry is structurally prepared for this type of outcome. Its size, cultural relevance, and political insulation allow it to avoid sudden failure while absorbing pressure gradually. This does not make the correction painless. It makes it uneven, opaque, and deeply asymmetric. The first mechanism of adjustment is silent contraction. Budgets shrink not through headline announcements, but through quieter recalibration. Fewer projects are greenlit, development cycles lengthen, and risk tolerance narrows. Content volume remains high enough to preserve the illusion of abundance, yet diversity and experimentation decline. The industry produces more of what is perceived as safe, not because it is profitable, but because it appears defensible. This shift reduces downside risk while also limiting upside potential, locking the system into a low-return equilibrium. The second mechanism is consolidation. Mergers, acquisitions, and strategic partnerships are framed as efficiency gains, yet they often function as debt management tools. Combining balance sheets allows companies to refinance obligations, cut overlapping costs, and preserve market presence. However, consolidation also reduces competition and innovation. Fewer decision centers mean fewer alternative models are tested. Capital circulates within a closed system rather than flowing toward new entrants or ideas. Historically, this phase marks the transition from expansion to entrenchment. Labor absorbs much of the adjustment. Employment becomes more precarious, contracts shorter, and compensation structures leaner. The industry externalizes volatility by transferring it to individuals and independent contractors. This approach stabilizes corporate finances in the short term, but it weakens the productive base. Skill accumulation slows, institutional knowledge erodes, and coordination costs rise. These effects accumulate slowly, making them easy to overlook until quality and efficiency visibly decline. Pricing experiments accelerate during this phase. Subscription tiers multiply, advertising returns, and bundling strategies reemerge. Each adjustment attempts to extract incremental revenue without triggering mass defection. The goal is not transformation, but survival within constraints. These measures can improve cash flow at the margin, yet they rarely restore the growth dynamics that justified earlier valuations. Instead, they signal a shift from expansion to optimization, a hallmark of post-bubble normalization. Investor behavior evolves accordingly. Expectations adjust downward, valuations compress, and patience thins. Capital becomes more selective, rewarding demonstrated profitability rather than potential. This transition is uncomfortable for industries accustomed to narrative-driven valuation. Projects once justified by strategic importance now face scrutiny over return on investment. This does not eliminate spending, but it changes its character. Capital favors predictability over ambition, stability over spectacle. The broader economic environment amplifies these forces. Higher interest rates increase the cost of servicing debt accumulated during the expansion phase. Inflation pressures consumers to prioritize essentials over discretionary spending. Entertainment remains valued, but consumption patterns shift toward efficiency. Audiences become more selective, less loyal, and more price sensitive. This reinforces the limits of pricing power and challenges assumptions about perpetual demand. Importantly, none of these changes require a collapse to be effective. The bubble deflates by losing its justification rather than its infrastructure. Studios continue to operate, platforms continue to stream, and stars continue to earn. What changes is the trajectory. Growth slows, returns diminish, and the industry becomes less central to speculative capital. The system survives by becoming smaller relative to its former ambitions. The final cost of this process is not measured only in financial terms. Cultural influence wanes as risk aversion dominates. The industry becomes more reactive, less visionary. Its output reflects constraints rather than confidence. This transformation is subtle, often rationalized as maturity or realism, yet it represents the end of an era defined by unchecked expansion and narrative-driven finance. In retrospect, the signs were present throughout the boom. Rising costs without rising margins, dependence on cheap capital, the insulation of decision-makers from consequence, the concentration of reward alongside the diffusion of risk. These are not unique to entertainment. They are familiar features of modern financial bubbles across sectors. What makes entertainment distinctive is how effectively it disguises them behind culture, glamour, and storytelling. The American entertainment industry will not disappear. It will adapt, contract, and recalibrate. But the version that emerges will be shaped less by creative possibility and more by financial constraint. The bubble did not burst in a single moment because it was never held together by one assumption. It was sustained by a network of incentives, beliefs, and protections that unwind slowly. In the end, the most revealing outcome is not collapse, but normalization. When entertainment stops being treated as an exception to economic rules and starts being judged by them again, the illusion fades. What remains is an industry still powerful, still influential, but no longer limitless. And that transition, quiet as it may seem, marks the true end of the bubble. The entertainment industry will not disappear. There will be more movies, more series, more platforms, more stars. But growth is not the same as health. Scale is not the same as sustainability. And visibility is not the same as profit. What you have just seen is not the collapse of Hollywood. It is the moment the illusion finally runs out of excuses. If this system keeps shrinking returns while growing expectations, someone will pay the price. Not the stars, not the executives, not the platforms. The cost always flows downward. So the real question is no longer whether this bubble exists. The question is how long it can survive once people stop believing in it. If you want to understand what happens next, follow the money, not the headlines. And remember, markets do not fail when confidence disappears. They fail when reality can no longer be delayed.